Hello everyone, and welcome again to Neddle, the best platform around for distance learning in business, finance, economics, and much more. My name is Sava, and today we're continuing our series of videos on investment management, and in particular today we're going to discuss portfolio optimization under various assumptions. Most of the time when you are considering Markowitz portfolio theory, modern portfolio theory, you are talking about normally distributed returns and mean variance optimization. But that needn't be the case. The logic of investor utility maximization can be easily extended to the cases when the return distribution is not normal and higher moments, such as skewness and or curtices, also contribute to investor utility. Well, portfolio optimization is generally a very simple to understand task. It's much harder to perform though. The goal of portfolio optimization is to allocate the investor's capital towards a set of feasible assets so that they obtain the best outcome possible given the constraints and given return and risk characteristics of feasible assets. Well, the simplest case is to consider a finite number of stocks and figure out the properties of their return distributions from historical data. That's exactly what we have here. I have extracted data on 5 years worth of stock prices for those 5 well-known US companies from various sectors so that we have some amount of industry diversification in our hypothetical portfolio. So Apple represents technology, Tesla is manufacturing, Walmart is consumer staples or retail, Caterpillar manufactures durable consumer goods or industrial goods, and Coca-Cola manufactures beverages. So here we've got 5 years worth of data on their stock prices, and as usual we just calculate the daily returns using a well-known formula for all of them. So that's straightforward. Then we will need to construct a number of portfolios. In our case, we'll construct 3 portfolios given various assumptions and see what are the properties of those portfolios that might be of interest to some investors. Well, first of all, what we need to do is we need to calculate the statistical moments of those return distributions. And if you are familiar with Markowitz portfolio theory, well, mean and standard deviation go into the mix without any question. So the mean return is just the average over historical daily returns. We can drag it around and get average daily returns for all 5 candidate stocks that we might want to include in our portfolio. Then our daily risk would be just the sample standard deviation. Again, a very straightforward way to calculate that. But if we depart from the famous normality assumption, then we will also need to consider higher moments. And most of the time, we'll just look at skewness and curtices. Bear in mind that there are indeed even higher moments than skewness and curtices that can contribute to investor utility and be reflected in their preferences in that or another way. But most of the time what we assume is that most of the distribution is described by the first 4 moments, so mean, variance, skewness, and curtices, and higher moments do not contribute much. How adequate is this assumption? Well, that's up for judgment. But again, most of the time we just are left with those 4. So skewness will just be skew of the area of those distributions, and we'll just drag it around again. And for curtices, we'll type in curt, and that will give us the excess curtices. So how fat are the tails as compared to a hypothetical normal distribution with the same mean and variance. Now, what we need to consider are those 3 hypothetical portfolios. Well, for the first case, we'll go with naive 1/n diversification. That's a very common baseline assumption that you use in portfolio management. In that case, if you have n stocks or any assets available to you, you just allocate your capital equally towards each of those available alternatives. So in our case, as we have 5 stocks, we will dedicate 20% of our investable wealth towards each of them. So 20% in Apple, 20% in Tesla, Walmart, Caterpillar, and Coca-Cola. And if we sum those up, we see that indeed we have allocated all 100% of our capital. That is a very important constraint, a very important criterion that needs to be satisfied in portfolio management, because, well, we want to allocate all of our capital into something that would make money for us, but we can't get free money from anywhere else. So that's why it should add up exactly to 100%. Well, in that case, for this simple structure of weights, we can really easily construct the hypothetical return of this portfolio day by day for our 5-year simulation. Well, here we'll just need to apply the sum product function, and the sum product function would multiply each element of the first array onto the element of the second array and add the results together. So we'll need to select the returns of our 5 stocks and then multiply them and add it then together by the weights that we have chosen. And in case of the weight array, we need to lock the row as the weights stay the same throughout the simulation period. So in this case, we just apply sum product, bottom right click it all the way down, and see what is the return distribution of this hypothetical portfolio. And in exactly the same way that we have calculated and considered the statistical moments and the properties of the return distributions of all 5 stocks, we can also apply the same logic to any portfolio with any possible selection of weights. So in that case, we can just drag those 4 formulas to the right and get mean, standard deviation, skewness, and kurtosis of this particular portfolio. Well, now let's approach this issue from a little bit more sophisticated point of view and assume that our investor actually tries to optimize their utility. In that case, how do we approach the problem? Well, we all know that the goal of an investor is to make money, so to obtain high return from their investment. But if we just consider the return maximization as the ultimate goal, then there won't be much room for any decision to be made. Well, the investor will just look at the stock that makes the most money, that has the highest return, and invest all of their wealth towards that. What is slightly problematic with this approach is that those returns that can be treated as expected returns, even in the Markowitz modern portfolio theory sense, are not granted. They're not guaranteed. The return process is stochastic. You can look into any disclaimer provided by any investment company or bank when they say that past performance is not a guide for future performance and that investment in assets does not guarantee to provide positive returns. So that's where risk comes into the picture. And if we account for the stochastic nature of returns, then we would have to discount our utility function by this term that involves standard deviation squared, or the variance of our portfolio. Please pay attention to the fact that this variance of the portfolio is multiplied by this constant called theta. And theta is the constant that denotes risk aversion of the investor. The higher theta is, the more risk averse our investor is. So it means that investors with high theta would be willing to sacrifice more of their expected return to have a portfolio with lower risk, lower variance. And that's all there is for utility function under normality assumption. But if we assume that skewness and kurtosis also play a role in return distribution and investor preferences, then our utility function actually changes to a more sophisticated form. Here we have the second and third term that reflect the investor's preferences regarding skewness and kurtosis. In that case, investors prefer positive skewness and hate or dislike negative skewness, and that is reflected by the plus sign over here. If skewness is positive, then utility would be higher, all other things held equal. If the skewness is negative, then the utility would be lower, because investors are excited about upsides and they are discouraged by potential downsides, and skewness shows you just that. Also, as we can see from this term here, investors dislike heavy tails and high probability of extreme losses or gains, extreme events. That's why here we have kurtosis -3, as bear in mind, kurtosis equal to 3 is the kurtosis of the normal distribution. So if we have heavier tails than we would have under the normality assumption, then the investor would be less excited about investing their money into that particular portfolio. If, on the other hand, the tails are flatter than that of a normal distribution, the investor is really excited because they are less likely to lose extreme amounts of money by allocating their cash into that particular investment option. And bear in mind that if we have a hypothetical case where skewness and kurtosis are exactly equal to those of a normal distribution, so we'll have skewness of 0 and kurtosis of 3, so excess kurtosis of 0, then those two terms will just disappear and we'll be left with the regular utility function that we are assuming when the normality assumption is in place. So when you're taking risk profiling questionnaires, you'll be assigned one of most likely 3 investor categories, which are in most cases called something like conservative, which is highly risk averse, balanced, which is moderately risk averse, or adventurous, which corresponds to low risk aversion. And it doesn't take much to understand that the value of theta for a conservative investor would be the highest, and most of the time it's assumed to be around 5. Theta for a balanced investor would be slightly lower, and most of the time it is assigned a value of 3.5 or any value from 3 to 4. And for adventurous investors, theta is even lower, and most of the time it is assessed around 2. And it is very obvious that as theta tends to 0, so as we decrease our investors' risk aversion, those terms, so the variance of the portfolio or any higher moments over here, would make much less sense to our investor, and at the limit, if theta is equal to 0 exactly, we would be reduced to this simple case where what our investor cares about is only the return, and they will just invest everything into Tesla. But this is unrealistic, as that's not what we really observe in the real world financial markets. So without further ado, what we can do is annualize the mean and the standard deviation of each of our stocks and the portfolio as well. So to annualize the mean, we'll just need to use the 1 plus daily mean to the power of 252, which is the number of trading days in the year minus 1. And for standard deviation, we should multiply the daily standard deviation by the square root of 252. And then we can drag that around and get the annualized values for all 6 return distributions. Now, for the utility functions, let's calculate the values for the utility function that assumes normality and that considers the third and the fourth moment, so skewness and kurtosis. So for the normality case, we'll just need to take the annualized mean and subtract theta times standard deviation squared, which is variance, divided by 2. and for the utility function for the higher moments, we'll need to also add the skewness and kurtosis terms. What is nice in that case is that skewness and kurtosis do not depend on the frequency. So the skewness of a daily return distribution would be exactly the same as the skewness or kurtosis, in that matter, for an annual return distribution. So we do not need to annualize those. So annualized mean minus theta times standard deviation squared divided by 2. That's just the same as in the previous example, plus, because we prefer positive skewness and we dislike negative skewness, theta squared times standard deviation cubed times skewness divided by 6, and minus, because we dislike heavy tails and we like flat tails, theta cubed times standard deviation to the power of 4 times, and here you would be tempted to say kurtosis minus 3, but the Excel function for kurtosis already returns the excess kurtosis. So we do not need to subtract 3 if we're doing this calculation in Excel, and divided by 720. So if we drag that around across our stocks and the portfolio that we've made, we can see that there are some notable differences in utilities of those stocks in those two cases. For example, an investor that disregards skewness and kurtosis or assumes normality would prefer Caterpillar over Tesla. This utility is higher than that. But if you take into account skewness and kurtosis, then Tesla becomes more preferable than Caterpillar. Why is that? Well, for the normality case, the reason why the utility for Tesla is so low is the fact that the daily risk, the standard deviation, is very high in comparison to Caterpillar. But that is offset by the fact that Tesla has high positive skewness, while Caterpillar has a high negative skewness. So skewness preference actually contributes to the fact that this utility is much higher than this. And given the fact that the kurtoses of the two return distributions are approximately the same, then the skewness is the factor that dominates in that case, and that's why Tesla is more preferable than Caterpillar for an investor that assumes non-normality or has skewness and kurtosis preferences. So, how to optimize your portfolio weights, how to determine in which proportions do you have to allocate your capital among the stocks that are available to you, given those two assumption sets? Well, we need to start with the same baseline cases, so equal capital distribution, equal capital allocation across those 5 stocks. You could start with any other baseline portfolio, it doesn't matter much, and check that the total capital allocation is equal to 100%. Then let's calculate return distributions of the portfolios that we will then change to optimize our utilities. So in that case, we can just copy this formula here and change these weights into those. And in the same manner, we can change the weights of the third portfolio to the correct ones. And then bottom right click those. And here, those will be exactly the same as we haven't changed the weights yet. But just to double check, we can calculate the first 4 moments and the annualized mean and standard deviation and the utilities. Now, what we will do is we will perform an optimization task. In the case of the second portfolio, so over here, we will optimize the weights, so change them so that we obtain the maximum utility given normality possible. So to do that, we need to go to Data Solver, set objective the utility function 1 to maximum by changing variable cells that correspond to the weights of the second portfolio, subject to the following constraints. We need to ensure that we invest the 100% of our capital into all those 5 stocks, so none is left and we don't go over the top, so the sum of weights should be equal to 1. And also we need to ensure that all of the weights are non-negative, because we're not allowed to short sell in that particular case. The addition of short selling to the mix is something I can talk about in later videos. As for now, we'll just assuming that we don't want to short sell any of the stocks. And now we can just click solve, and the solver function would assign the weights to those 5 stocks so that this utility, which is given by the simple utility function, is maximal. Now, for the second case, when our investor assumes non-normality or cares about skewness and kurtosis, we can do exactly the same procedure, but in that case, we need to maximize the second utility function by changing the weights that correspond to the third portfolio and holding those weights non-negative, and holding this value, the total sum of new portfolio weights, to be equal to 1. And then we click solve, and we get another portfolio that would be best under non-normality. And in that case, we see that the value of the second utility function is greater than in the case of the second portfolio, because, well, we optimized it, so that's about natural, while the value of the first utility function decreases, well, because we optimized it in the case of the second portfolio and didn't optimize it in case of the third portfolio. But if we look at the weights, we can see some interesting changes that has been made to the asset allocation. As we see, in case of the second portfolio, we allocate quite a bit less of our funds into Apple and quite a bit more towards Walmart, while the allocation to Tesla remains roughly the same, albeit decreases slightly. And given the fact that we know the statistical moments of those stocks, we can speculate why is that the case. The investor that cares about skewness and kurtosis wants to disinvest from Apple as its skewness is negative, while Walmart, provided its high positive skewness, is actually a preferable investment opportunity. And that's all there is for portfolio optimization with higher moments. Hope you found this video helpful. Please leave a like if that's so. In the comments below, please suggest any further topics in business, economics, or finance you want me to investigate, and don't forget to subscribe to our channel. Thank you very much, and stay tuned.